Hello, everyone, and thank you all for joining. I think it's 1 o'clock Copenhagen time now, at least. I am Jakob Falkencrone, and I'm global head of investment strategy here at Saxo. And I will try to help you make sense of these crazy, indeed, markets that we have at the moment and what it means for U.S. investors. Before we start, I'll just say that none of what I say today should be seen as investment recommendation or investment advice or anything like that. Everything here is for information and inspirational purposes only. And yeah, you shouldn't trade on anything you hear from here. It's just to inform you about the current market situation and what's going on and how we see the world. So yeah, if you have any questions, we will also try to go through some of them in the end. There is a question tab in the top of your screen, so please post them in the questions tab and not in the chat, so we can see them and go through some of the most relevant ones. We will have quite a lot of people joining our call today, so we'll probably not have time to go through all of the different questions, but I will try to gather as much as possible, and hopefully we will also cover a lot of the questions during these presentations. But yes, as I said in the beginning, I mean, we are indeed living through some of the most exciting times, you could say, as an investor. Some of the largest volatility that we have seen, and everything, you can say the common ground for everything is that it's triggered by one man. So President Trump here with his someone call it the chart of death or the board of death, because it has really, say, shocked or panicked the financial markets since April 2nd, which he dubbed his Liberation Day. I don't know about you, but I don't feel that investors have been feeling quite liberated over the last week or so, more liquidated. We had a good day yesterday. I just took a screenshot of my can say Bloomberg overview of different markets. As you can see, there's still a lot of reds on the 5-day, 1 month, and 3 months, so on. But on the one day, we are actually pretty good up. Of course, after what we heard yesterday from Trump, we saw some pretty big spikes in the market, and we also yeah, saw some short-term relief at least. But I will come back to that in just a second, because things is of course evolving very quickly at the moment. It's evolving by the hour. I was having another webinar yesterday for some Danish clients, and just while I was speaking, I had a note handed to me that now China retaliated with 84% tariffs on the US. So everything is really, really uh, evolving very, very fast. And you can say, unlike other situations that we have had, for example, or sell-offs like we have had with COVID or something like that, everything is inflicted by one man, and the acts of politics and the acts of Donald Trump. So you can say different from what we saw during COVID. Uh, the easy fix, of course, the easy solution to all of this would just be to roll all of this back, and then markets would be great again. It doesn't seem that's the case, unfortunately. But yeah, we will try to cover most of that going forward. I hope we will wrap this up within a half an hour or so, and then we'll have some time for questions in the end. But yeah, what's going on in the market right now? I mean, simply put, we have a lot of uncertainty out there, and all of this uncertainty, as I said, is coupled with America's or Donald Trump's uncertain today tariff policy. And over the last week, we have seen some quite historical, unprecedented moves by the U.S. and some of the steepest say tariffs we have had in more than 100 years. So we should actually go back to all the way to before the Second World War to see anything like this. And that is of course something that has unraveled markets, because the world global markets or the global economy is built on, say, capitalist principles and free trade principles, and you can see it as some kind of spider web So if you disturb some part of it, then everything starts to shake, and that's really what Trump has done here, by imposing these tariffs that were much larger than what we expected. I think going in, Trump has been saying all along, since the election campaign, that he would impose these tariffs. That was also some of the policy that he had during Trump 1.0. I think the market didn't really anticipate that he would do it in a manner that he actually did. So I think what he actually imposed on April 2nd was far worse, somewhat worse than most experts and most analysts thought and expected, with these very large tariffs on all of the different countries above this 10% baseline for all. What happened then yesterday? As we can see, the market has been extremely driven. This is the S&P 500 over the last month. So you see about April 2nd, the market just took a plunge. We had a little bit of relief the other day, but yesterday we saw the big spike. And what you say twisted the story yesterday was that Trump blinked, you can say. So after watching this market free fall, also after watching some of this actually go into the bond market as well, we normally in a situation like this, we would expect to see uh, dropping uh, equity markets that would cause investors to go out of equities, go into what we call safe haven assets. That could be treasury bonds, for example, in the US. But what we've actually seen is that they have also declined in price, meaning that interest rate has gone up. So we have actually been a quite unusual situation where we have seen sell-offs in both equities and bonds, causing the U.S. Treasury yields, the longer ones, especially 10 years, to increase quite dramatically over a couple of days. And that means that yeah, Trump was very pressured. I mean, we have a high inflation in the U.S. But they also that was one of the things he promised voters that he would fix. We also now started to see high interest rates and large plunges in say the equity markets, and the overall pressure against Trump, both from his administration, from CEOs from other countries, had they piled up quite a bit. And yesterday he then went out and said that he would pause all of these reciprocal tariffs for 90 days, so 3 months. You say what is very crucial here, and what is important is that the 10% base rate tariffs will remain, and China is also excluded from this pause. So, effective immediately, Trump also raised the tariffs on Chinese goods from 104% to a say whooping 125%. So now China has a 125% tariff rate from the US. China, as I just said the other day, they retaliated with 84% to US. Right now, they are talking about what they should do. But if actually all of the other countries in the world have a 10% base rate right now, except also Canada and Mexico, they have still the 25%. So there's a lot of uncertainty still. But what we saw yesterday was that the market really exploded on this tariff announcement. As you can see here, it was somewhat extraordinary. The S&P 500, the largest index in the US, was up 9.5%, and the Nasdaq, which is like tech heavy, was up more than 12%, which was the best day since the early 2000s. So it's quite historic what we have seen, these moves that we have seen, and also if we look at some of the you can say swings in price, or some of the volatility that we have seen both intraday but also just so many days in a row. I mean, it's only back to periods like COVID and periods like the Great Financial Crisis we have seen anything like that. Maybe also the flash crash in '87, but we are, I mean, in the very rare type of event where we've seen this plunge in equity markets and this panic that has been quite widespread. So what we saw today was this kind of release, and I would say there is a lot of maybe relief and hope in the market, at least temporary, because the market has kind of yeah, saw that Trump in the end capitulated to the markets, you can say. And it's in such kind of environment where markets has been expecting or bracing for the worst, then they take every sudden signs or sudden hints of some kind of negotiation very positively, and that's why they have been rallying so much. European markets are up today as well, also quite a lot. So they are catching up on the US. But I mean, if we're looking at the US market, it's actually down. It's not open yet, but the futures point to a negative opening. So the question is, of course, how much this positive or much a little bit more positive sentiment can go on, because I think even though now we talk about there's a pause on some of these tariffs, it's extremely important to underline that this hasn't fixed the issues yet. I mean, as I just said, I mean, we still have the 10% tariffs on the imports for all countries. We still have a trade war. I mean, economic warfare almost between the US and China, the two biggest economies in the world. We still have tariffs on autos. We still have tariffs on Canada. We still have tariffs on Mexico. So Mexico, Canada, and China, those are some of the three largest you say trade partners with the US. So this is still very significant. I mean, going back, and if we expected, I mean, the tariffs that are in place for now with all the pauses, that will still be a pretty bad scenario. So I think it's important to think that yes, we got some relief yesterday. Yes, things are definitely in the very short term looking a bit more positive, but just a bit more positive doesn't mean that it's good. So I think it's pretty much like the market has been holding its breath underwater, and then yesterday maybe they finally got a gulp of air, and then they of course go for some joy. But I think it's still important that there is a lot of volatility out there. There's a lot of uncertainty going forward. You say, how will this impact some of um, the U.S. households, because they are an important factor in this. I mean, a lot of this has been about Trump wants to get production back to the U.S. I don't know how valid that, say, thought is. I don't know whether he expects Americans sitting there and assembling iPhones and producing iPhones. I just took this one from the Wall Street Journal, showing, I mean, how a tariff would raise the price on an iPhone from $500 to $800, and that was with the first level of tariffs, so 54%. Now we at 125%, so you can probably basically double that. Um, and we have also seen some say best guesses about if an iPhone indeed was to be produced in the US, that would raise the price of an iPhone to like $3,000, which is of course also unsustainable. So and also back to one of my points, I mean, this is still an issue. We still have this issue. We still have a lot of these goods being produced out of Asia, out of China. Say the average U.S. household will still see significantly higher prices in the short run. We also saw some numbers the other day about, I think it was the University of Duke or something like that, that estimated that the average, say, expense or a U.S. family would rise around $3,800 on an annual basis. And just remember that a lot of these, say, average Americans don't have money like that. So it's something that they will feel quite significantly, and it's also something that is important. You can say, because all of Trump's voters will be hit with that. We have actually already seen, or there's like news that people have been rushing out to buy some of those things that will be hit by tariffs: rice, canned food, vegetable oil, maybe new televisions, some of that stuff, tires. We have also seen someone who've been talking about going out and buying a new car just now because it will increase in price. So this will be felt by the American citizens, and this is of course something that is also piling up on Trump, uh, and put some pressures on him, because as I said in the beginning, Trump has been I mean, one of the things he promised during the election campaign was that he would fix the inflation, and that he would also, now that he has been talking about lower interest rates. I mean, right now we're seeing the mortgage or the long-term yields go up, so it becomes more expensive to finance your debt as a household. And now all of a sudden, a lot of things will start to be much more expensive, which is also hurting his, you can say, voters a lot. They have been talking a lot about the price of X, how they have surged. So you can say, imagine how things will be if everything all of a sudden increases significantly in price. So yeah, there's a lot of internal pressure on Trump. What will happen during the next 3 months is, of course, an extremely good question. We have this, as I just said, we had this 90 days tariff pause. And as I said, this is only a pause. This is not a permanent solution. So what we basically have is a 3 month window now, or 90-day window, to start negotiating with trading partners. And as just Trump said the other day on, I saw some quote that he's saying, and this is a literal quote. He said, "A lot of a lot of countries come kissing my ass, and want a good deal." So now he's of course negotiating with all of these, or some of them at least. What happens in this 3 month window is of course difficult to know about. I think in 3 months' time we will still have the same issue as we have today. So that's not really going away. And you can also say that if you really want to have, normally when you do like trade agreements with countries, it's piling up hundreds or even thousands of pages because you need to be extremely detailed. Trump has said that he has been receiving calls from 75 different countries who want to make deals with him. All of the countries, he says, come and kiss his ass with deals. So of course they can't just negotiate 75 different agreements within 90 days. So there is of course some kind of you can say a possibility that this will be prolonged when we approach those 90 days, but we don't know anything about it. So right now there is a lot of questions. Maybe there is even more questions than answers, because what will happen to the consumer impact, what will happen to the you could say business sentiment. If you have a business right now in the US, if you want to invest, if you want to hire people, what should you do? Should you wait? Should you just take a gamble with your money, with your company? There's a lot of uncertainty that will hold back investments and activity within the sectors. And then there's the consumer impact, as we just talked about. I mean, how will consumers act? What will China do? There was just a headline half an hour ago that China will restrict some of the U.S. companies to go into China. And as I said, it's evolving by the hour. So we really don't know what will happen here. And that's also why I say yes, there is certainly some relief in the market, but it's relief. It's not driven by the fundamentals, because if you look at the backdrop, there is certainly still a lot of uncertainty. And that's also why I think over the next 3 months, over these coming 90 days, where we have this pause, there will be a lot of volatility still out there, and there will be a lot of headline-driven news. So every time Trump is going on Truth Social, his personal Twitter account, or X, um, it will probably rock, or it could probably rock the markets. I mean, just the fact that we have a president of the United States unraveling the markets with the most historical trade, say, conflict since more than 100 years, and then he goes out on Twitter and stops it everything again after a couple of days. It's just, yeah, it shows how crazy this situation is. And it also, I mean, I think one of the damages this has done, and that was also a bit linked to what I said in the beginning about, or earlier, about the increase in U.S. bond yields that we have seen, is that I think there's a lot of trust to the U.S. administration that has been removed. The way that Trump and the administration have acted and treated everyone alike, both his friends and his enemies, just slamming everyone with a tariff, that has been an extremely large own goal from Trump, and I think he has lost a lot of credibility, and the U.S. has lost a lot of credibility, and I think Europe has been wise not just to sit there and watch him self-destruct over the last couple of weeks, instead of going out and retaliate. So yeah, there is a lot of uncertainty still out there, and there is certainly uh, room for, you can say, this getting worse again before it gets better. So I think right now these 10% will stick for some time, and then there will be a lot of headline driven news over the next couple of months, and yeah, that's something we will. And then of course the big question is what China will do. I think, if you ask me personally, I don't think, I think both President Xi and China and Trump, they are extremely they want to win. You can say they are these big, strong men who don't want to blink. Now Trump blinked for the rest of the world, but I think his main priority in all of this has been to hurt China and to decouple China from the U.S. And that is still his number one priority. And if you have, you can say, two of the largest countries in the world, the two biggest economies, having 100% tariffs on each other, that's basically the same as saying we are not trading with each other. Because I mean, even though he increased the tariff rate to 200%, I mean, the marginal effect of that wouldn't be that significant, because already at 100% they are not really trading with each other. So there's a lot of uncertainty still out there over the next couple of months. I just want to show this as well. I mean, we talked about, I mean, the historical aspect of how crazy this volatility has been. Here is the VIX index. The VIX is showing, you can say, how much volatility is priced into the market. So how much does traders think that that the prices will move over the coming period. And as you can see, I mean, we have been at historical levels, only higher in doing like global financial crisis, the IT bubble, and COVID. So we have been at historical levels. I also brought this one on the right side because I think it talks a little bit to what I also said before about the credibility of the U.S. During all of this madness we have been, this was what Donald Trump spent his weekend on and posted on his Truth Social. So while the whole world was burning and trillions of dollars or euros were, say, vanishing on the stock markets, he was playing golf with his friends at his golf course in Florida. So that's kind of just shows how crazy this all of this is. And going back to what I said, I mean, what we saw during COVID was that we had this extreme situation in the world that we need to take care of. We also saw some central bank going out of support quite significantly, but this time it's totally self-inflicted. It's one man who is doing all of this to the economy, and he could, in one blink, take it all away again if he wanted to. So that's kind of the major situation or major difference between this situation we see right now and what we have seen earlier. Just a little bit about again the, you can say, severity of this sell-off. Now we have rebounded, as I said, but just, I mean, this is actually the second fastest 20% drop we have seen in history. Only yeah, only one faster was during COVID. So it's the black line here, as you can see. That's 2025. So this just shows, I mean, how fast this has been happening, and what has really been going on at the market. Everyone is Not everyone, but a lot of people have been talking about recessions, whether this could lead to a recession in the US and also globally. And there has been a lot of say thoughts about that, and there has certainly been a high risk for that. I have looked into how stock markets have been doing in all of these recessions. You can see here I've mapped all the recessions since the Second World War. We've had 13 of them. So should investors be worried for that? That's the number one questions. I tried to I brought this analysis. It's a bit busy, this slide, but on the left-hand side, you can see what is a drawdown doing a recession. And on the right-hand side, you can see You can see the numbers, and you can see that on average a recession lasts 10 months, and that you can see the drop down in the market is around 30%. Looking at all the bear markets, a bear market is when the S&P 500 has been lower than 20%, so a larger than 20% drop down. That's around the same. So if we indeed were to go into a recession, we could see significantly lower stock markets from here. That's just what we are trying to say here. So if we are heading for say a worse economic outcome, then we should also probably go lower on the equity markets than we have been here. So that's just to say a little bit about it could be worse before it gets better. Having said that, I think it's important to remember as well, going back to the slide again, I mean, this chart speaks for itself. I mean, the direction of the stock market has been up, and historically speaking, no matter what you have tried to um, how you have tried to hit the stock market out of its rhythm. It has been going upwards ever since, and historically, all you can say major crises, major wars, trade wars, everything, pandemics has been recovered again. So it's just important to remember during times like this that it's important to have a long, time horizon, and stay calm, and remain focused on your overall strategy and ambitions, because it's extremely easy when you see these large swings, five, seven, 6, 7 percentage points volatility within a trading day, then there's a lot of people who gets scared. So it's just important to remember the big picture here. Also brought this one just to give you that kind of you can say example of why it's important to think about the long term, and why you shouldn't go out of the market, even though there's a lot of uncertainty. On the left hand side, we have how quickly markets rebounded after hitting the bottom in 2009 during the great financial crisis. As you can see, 3 months after, it recovered 48%, and just 1 year after, 80%, and 2 years after, more than 100%. So if you say are on the sidelines here, if you are out of the market with just some of your portfolio in cash or so during this recovery, then you lose out on a lot of returns. So if we say that the going back over the last 100 years, the stock markets has been yielding around 8% in average annual return, then if you are out these 12 months, you're actually missing out on 10 years average return. So that is quite significant, and that is not a mistake you should make many times in your life as an investor, because then this will get very, very say difficult for you to reach your financial goals. And I also brought the MSCI World Index here on during 2020 and 20 during the COVID, where we also saw that within a few weeks, the market sold off more than 30%. But by August, it was already recovered, and by December, the market was up 14%. So everything can move very, very fast. That was also what we saw yesterday. I mean, 10% return days is not something that we see a lot. So just going back to what I just said before, if you can say on average expect around 8% per year, then just yesterday you got a whole year of returns, and that is of course something that is important to remember. So that's kind of speak to this about don't missing you shouldn't miss the best days of the market. This is a little bit, you can say, uh, this is just an example of how important those days are. Because if we look at the global equities here, MSCI World again, over the last 15 years, you would have had a 300% return if you stay invested all along without doing anything. If you miss just the 10 best days, you could have that return, and if you missed the 30 best days out of those 3,900 days, then you would actually lose all of your return. And you can see, yeah, the numbers adding up here. And of course, no one in the world is that unlucky that they will just miss out on the 30 best days. But if we look at I mean, the 30 best days and when they occur, that's always after some of the worst days we have seen. So, for example, the last couple of days has been pretty bad. So before yesterday, I mean, if you sold off on Friday or on Monday when we saw the big swings, then you would have lost out on 10% yesterday. And that's just mean that if you are out on some of these best days, then it's just very, very difficult in the long run to recover that. So yeah, this just speaks to the fact that right now we have so much uncertainty, we have so much volatility in the market, that now it's not the best time to go out and make say radical decisions about changing the whole portfolio and selling out and stuff like that. Of course, you should be comfortable with the level of risk you have in your portfolio, but overall, it's not the time to go out and sell everything. So yeah, stay calm. So what could investors do now in this uncertain environment that I've talked about? I would say, yeah, don't panic. Should not try to time the market, as we just talked about. Missing these days is you can say uh, reduces the return dramatically of what you can expect in the long run. I think the number one piece of advice that we give is to stay disciplined and also follow, of course, your investments and rebalance. So if you have some kind of you can say imbalances in your portfolio, you should of course try to make sure that everything is diversified and you have a solid portfolio that is not only centralized in a few US mega cap stocks. So I think right now it's really the time to diversify. It's something that we talk about more than ever. It's something we talk about all the time, but I think right now more than ever, it's really important to diversify, and we have actually said that since the start of the year, where we saw those somewhat large underperformance of the U.S. market relative to the rest of the world. We've had a lot of years where the U.S. has been the place to be, and we've actually had some years where volatility, no, not volatility, but where the diversification wasn't really the you can say winning strategy, because just buying Tesla and Nvidia and some of the other ones would guarantee you a lot of success. So um, yeah, but right now that narrative has changed quite dramatically, and I think we should of course start to diversify a lot, and that's kind of the one free lunch that you get here. That is what you can do. And then I mean, there's a lot of people asking, is this a time to start for to buy up? I mean, to buy and buy the dip, and should we focus on yeah, some of these companies that has been reduced a lot, and I think that depends on your, of course, level of risk tolerance and how risk willing you are. I think if you start to use this dip as an opportunity, you should be extremely selective, first of all, and you should be very strategic and also very deliberate in what you do. It's this is, I think, as I said, I mean, there's a lot of volatility still out there. Now we had the best day in 20 years yesterday. Now the market is down again in the US, probably a couple of percent. So there is a lot of volatility out there. So don't just think that just because something has decreased in price, then it will be a very good buying opportunity. So there is a risk out there, but I mean, if you have cash on the sideline, or if you want to invest, of course, there's a lot of high quality companies that has been that looks cheaper now than they did 2 weeks ago. So you can start like say gradually increasing your exposure. You can add some of those to the watch list, and then see if something should be bought at some time. That could be a thing. I think a lot of people also focus on some of these what we call the defensive sectors, or more resilient or stable sectors. I think one of the things we have seen in this market environment is that nothing has really been defensive. You can't really hide anywhere. Everything has been hit. Only places we have seen some good returns has been in gold and German bonds. So that has kind of been the safe havens for now. But of course, maybe some of these maybe yeah, high dividend companies with strong balance sheets and a stable say business model. Also utility companies, maybe also something like healthcare could be a defensive play. But of course it is difficult, and as we also know that, I mean, Trump was out the other day saying that he want to put a 25% tariffs on all pharmaceuticals, and if that happens, I mean, then you say healthcare sector also, uh, yeah, that's not probably not really a defensive play anymore if that kind of political risk is there. So yeah, there's a lot of things going on, and I think right now it's just a waiting game for these 90 days, and of course if we could see whether I mean, is this over or are we just getting started? I mean, the optimistic scenario would of course be that we have these 90 days now, market stabilize, tariffs are negotiated successfully. Maybe we could see a 10% baseline tariffs, but I mean, it's still better than I mean, the first things we saw. The more pessimistic scenario would of course be that some of these negotiations starts to fail. Could also be that Trump pivot and make a U-turn. We have seen that before. We also have this recession risk, say, prevailing, and even though that we saw Goldman Sachs was out yesterday saying that they thought now that the U.S. was heading for a recession, and then after he Trump pulled back on his tariffs, they were out saying, okay, now we don't think it anymore. But there is certainly still a risk, and there is a lot of market participants or professional analysts who say that there's like a 50% chance of going into a recession, even in the scenario that we have right now. So there is, of course, if you take on your pessimistic glasses, there is a lot of things to be worried about right now. And with Trump in the White House, we don't really know what's happening. So that's also why I say, I mean, keep a balanced, diversified portfolio. So that's basically the best thing you can do right now. I think that was all I had on the agenda for today. There is a lot of questions. I will try to see what we can go through here. Someone asked whether Trump's on-off game is also some kind of stock manipulation. Um, I would say yes, almost, but I don't know. But what we also saw yesterday was actually 2 hours before or 3 hours before the announcement of these tariffs, he was out on his Truth Social saying now would be a good time to buy. And then 3 hours later, he announces this tariff, pause. So I mean, if you can come on the inner circle of Trump, there is probably be a lot of returns to be made. But yeah, what we have seen right now is just, I mean, yeah, extraordinary. And it seems like it's just something that he takes out of his head. There was some kind of coverage of how it went yesterday, that he was actually just sitting in his in the Oval Office with Lutnick and Scott Besson and some of his advisors, and then they just figured this out, and then they send out a tweet or a truth without consulting any legal you say legal people at all. And at the same time, we actually saw that one of the, say, trade representatives was in a hearing in the Senate, and he was just, I mean, he was just blindsided because he didn't know anything about it, and then he would just, yeah. Being killed by some of those senators with very rough questions. So I think this is just something Trump is taking out, and it's extremely difficult to figure out what's going on. Other questions? There was a lot of questions about exchange rates. I think yeah, I'm not sitting with the FX, but our FX teams is say very positive on the euro going forward. So strengthening of the euro relative to the dollar, and that would probably continue. And then there is a lot of questions about what will happen after 90 days as well. I think we covered that already. But yeah, the only answer is we don't know. This could go on. I think it could be prolonged after 90 days, because I don't think we could solve anything in 90 days, as I said. And in 90 days, we still have the same fundamental issues. So this could be prolonged. but that will just mean even more uncertainty going forward. So yeah. Did you say anything, Alex? Did you spot some?
Yeah, just on a small note, we got a lot of questions regarding the recording on this webinar. As always, this webinar has been recorded, and we will make sure to upload it on the website and platform afterwards, and we'll make sure that you guys can have the PowerPoint as well.
Yeah.
Yeah, I think you covered a lot of the same questions as far as I can see.
Yeah.
Yeah.
Cool. But with that covered, I will just say thank you very much for joining us this afternoon, and hopefully we'll get some good trading days going forward, at least better than what we've had over the last couple of weeks. But as I said, yeah, buckle up and brace for what's next, because it will probably still be yeah, an uncertain, volatile environment that we're operating in. But yeah, thank you for today, and goodbye.